Welcome to the deep dive. Okay, let's unpack this. Today we're sifting through, well, a whole stack of fascinating updates. Business, tech, policy, stuff that's really shaping our world. Our mission, like always, is simple. Get you quickly informed, connect some dots you might not see, and highlight those surprising facts. We've looked at earnings reports, tech launches, policy changes, market trends, even some legal stuff.
Yeah, and what's really fascinating here is how these headlines, they might seem separate, celebrity campaigns, quantum computing, but they actually reflect these fundamental shifts, changes in how we behave as consumers, tech advancements, government's role in the economy. We'll try to get into not just what happened, but, why it actually matters for you.
Okay, so let's kick off with how companies are grabbing our attention and what that means for, well, our wallets. American Eagle Outfitters, AEO.
Yeah.
They just released their Q2 2025 earnings, and they absolutely smashed expectations. I mean, earnings per share were more than double what analysts predicted, revenue beat forecasts too, and the stock, it just soared, over 20% in after-hours trading.
Wow. That's a big reaction.
It is, and the CEO, Jay Schottenstein, he pointed directly to their marketing, specifically campaigns with Sydney Sweeney and Travis Kelce. He credited them for a clear uptick in customer awareness, engagement, and comparable sales.
So the celebrity factor really moved the needle then.
Seems like it. For instance, that Sweeney campaign, the one with the slogan, Sydney Sweeney has great jeans.
Yeah.
But it apparently led to denim sellouts, double-digit traffic growth. Plus, they had this Sydney jacket and Sydney jean, tied to charity, sold out in just one day. And the Kelce partnership, even bigger numbers, drove 3 times more sales in a single day than past collaborations did in a whole week.
3 times in one day. That's impressive leverage.
Yeah. Now, that Sweeney campaign, it did shit things up a bit. There was some controversy. You had some critics on the far left talking about a possible eugenics double entendre. Then others, including President Trump, actually called it the hottest ad around. And then just general comments about ads being, overly sexualized or maybe out of touch.
Right, so a real mix of reactions.
Exactly. But our sources suggest AEO basically saw it as a win for engagement, despite the noise. They did mention some challenges, though. Merchandising missteps, the uncertain consumer, and tariffs, definitely tariffs. Their full-year operating income guidance, they revised it down, mostly because of those tariff costs. But it's not just AEO, right? You see Abercrombie & Fitch, Gap, Levi's. They're all leaning into these celebrity and influencer strategies, too, trying to cut through.
Well, what AEO's experience really shows, I think, is how in this fragmented media world we live in, controversy itself, it can almost become marketing currency. It's risky, sure, but it can drive incredible engagement, direct sales just by tapping into public discussion. To stay relevant, like they say, sometimes you have to provoke, and the tariff thing, yeah, that's the ongoing headache for retail, isn't it? Even shifting production out of China, like AEO did, doesn't fully solve it. They're still exposed in places like Vietnam and India.
Right. And this focus on, attention and wallets, that brings us nicely to a new policy, something that could directly help a lot of you listening, a new tax deduction. President Trump's big, beautiful bill includes this no tax on tips idea. Basically, from 2025 through 2028, if you're eligible, you could deduct up to $25,000 in qualified tips each year. And it's interesting, this idea had kind of been floated by both parties before.
Okay, so $25,000 deduction on tips. Who qualifies?
Well, the Treasury put out a preliminary list. Dozens of jobs, things you'd expect, like bartenders, waitstaff, gambling dealers, massage therapists, but also taxi and rideshare drivers. Basically jobs that customarily and regularly receive tips. And the way it works is pretty simple. It just reduces your taxable income. You don't even need to itemize deductions to take it. Just a couple of caveats. It phases out if your income, your modified AGI, goes over $150,000. And importantly, state taxes still apply. And so do federal payroll taxes for Medicare and Social Security. Those are still based on the full tip amount.
So it's a federal income tax break specifically. What this really brings up is how policy can directly shape, well, your financial situation and the job market itself. It's a clear benefit for tipped workers, no doubt. But also makes you think about targeted tax breaks, How do they fit in the bigger picture? And the Treasury having to list specific jobs, that just shows how complicated it gets to implement these things fairly.
Okay, let's switch gears now. Let's dive into tech. Because we're seeing some really incredible leaps here, from the actual chips powering AI to new ways we interact with software. Take Nvidia. They basically cemented themselves as the world's biggest company. Market cap, $4.2 trillion, just staggering. And the stock performance, an eye-popping 1,100% surge since early 2023, almost entirely driven by demand for their AI chips.
It's been an absolute meteoric rise.
Totally. Their latest quarterly revenue, up 56% year over year. And the data center part, that's the AI chips that made up 88% of it, just huge. And they've just started shipping their new Blackwell Ultra GB300 chips. These things deliver, get this, 50 times more performance than the old H100 chips in certain setups.
50 times. Wow.
Yeah, and they're designed specifically for these really complex AI models. The reasoning models like OpenAI's GPT-5 or Anthropic's Claude 4. Apparently, these models consume up to 1,000 times more tokens, which are basically the pieces of data AI processes.
So the hunger for processing power is just exploding exponentially.
Exactly. CEO Jensen Huang thinks data center operators could spend up to $4 trillion on AI infrastructure by 2030. And their big customers, Alphabet, Meta, Amazon, Microsoft, they're already forecasting over $350 billion in annual spending combined. But interestingly, despite all this growth, NVIDIA's valuation, its PE ratio, is actually trading at a discount compared to its 10-year average. And there's maybe more upside coming with their next chip, the Rubin architecture.
You know, the key thing with NVIDIA isn't just faster chips. It's that these chips enable completely new AI capabilities, especially for those complex reasoning models you mentioned. This demand wave, it really highlights a fundamental shift in how businesses run, how tech is built, and the sheer scale of investment. That $350 billion annual forecast from just 4 companies, it's unprecedented. It shows they believe we're still, in the early innings of this whole AI transformation.
Right. And it's not just hardware. We're seeing innovation in AI applications, too. Look at DeepL, the German startup. They were known for AI translation, valued at $2 billion. Now they've launched this new thing called DeepL Agent for businesses.
An agent, what does that mean exactly?
Well, think of it like an AI tool that can just work in the background. You give it a prompt, and it carries out tasks. Stuff like automating repetitive, time-consuming things across different departments, HR, marketing, you name it.
Yeah.
The CEO, Jared Kudilowski, sees it as a sort of natural next step from their translation product. Help solve tedious tasks.
Okay, so automating workflows.
Pretty much. But now they're jumping into a really competitive field, right? You've got Microsoft with Copilot, Anthropic with Claude, OpenAI. The market for these AI agents is still, well, very early stage. But investors are clearly interested. Anthropic just got funding at a $183 billion valuation.
$183 billion.
Wow.
Wow, that signals huge belief in this agentic AI space.
Definitely. And we're seeing AI integrated elsewhere, too. Figma, the design software company, they just had their first earnings report since their IPO. Revenue was up 41% year over year, beat expectations, good guidance too. And they announced new products, Figma Make, that uses AI to help design apps and websites, and Figma Sites, which actually turns those designs into websites. Their CEO, Dylan Field, his take is that AI isn't replacing designers. It's making their human touch even more critical.
And that connects back, doesn't it? This is really about how AI is starting to reshape workflows, maybe even job roles, DeepL moving into agents, Figma putting AI into design. It points towards a future where AI handles more of the, let's say, mundane tasks. That potentially frees up humans for more creative work, more strategic thinking. It's a really good example of companies trying to use AI to enhance human abilities, not just replace them. It changes how work gets done.
Now let's step right to the cutting edge. Quantum computing. There's this Finnish startup, IQM. They just raised $320 million. That makes them a unicorn valued over $1 billion.
Quantum computing still feels a bit sci-fi, but the potential is huge.
Exactly. The promise is they can solve problems that are just too complex for today's classical computers. They use qubits. Unlike regular bits, which are 0 or 1, qubits can be both at once, sort of. It lets them process way more information, exponentially more. Potential breakthroughs in medicine, science, finance. That's the hope. And IQM. They want to rival Google and IBM, building these powerful machines right here in Europe.
Building them in Europe. That's interesting given the funding landscape.
It is. Investor buzz is definitely there. You see public companies like IonQ, D-Wave, Quantum. Their stocks have had huge rallies this past year. But yeah, European startups like IQM often find it harder to scale. Less private capital compared to the U.S., like the EU gets maybe 5% of global private funding versus 50% for the U.S. Despite that, IQM is pushing ahead, developing a software platform, expanding globally. They've already sold systems in Asia, and now their first one in the U.S.
Yeah, the significance of quantum, even now while it's early, it really represents that next big leap in computing power. It could fundamentally change industries that rely on heavy-duty calculations. IQM getting that big funding round, especially as a European company, shows there's still strong confidence in the long-term potential, even if widespread practical use is still a ways off.
Okay, shifting back to big tech giants and their current headaches, Apple. They're still dealing with tariffs. Even though CEO Tim Cook has done a lot, planning that $600 billion U.S. investment, moving supply chains to India, even getting some chip tariff exemptions from President Trump. They still paid $800 million in tariffs costs last quarter, and they were forecasting $1.1 billion for this quarter.
Ouch. That's a direct hit to the bottom line.
Absolutely. And it's got analysts thinking, like Edison Lee at Jefferies. They're now expecting maybe a $50 price hike for the next iPhone, the iPhone 17. Apple's usually pretty careful, judicious with pricing. Base iPhone prices have crept up over the years. This time, a price increase might be wrapped up in new features, bigger screens, more memory, AI chips, or maybe more subtle, like getting rid of the cheapest storage option on certain models, like the iPhone 17 Pro. JP Morgan thinks that might happen.
Right, so they might frame it as more value rather than just a straight price hike. But what this Apple situation really underlines is that complex dance between global supply chains, trade politics, and what you end up paying. Even a behemoth like Apple isn't immune. So for you, it means these big geopolitical forces can directly lead to higher prices for the tech you use every day. Even small price bumps add up.
And in other tech news affecting big names, Disney just settled with the FTC, $10 million. It was about unlawful collection of children's personal data on YouTube. Basically, the FTC alleged they didn't label some videos correctly as made for kids.
Ah, the copy-pay rule.
Exactly, Children's Online Privacy Protection Rule. Because they weren't labeled right, YouTube apparently collected data from kids under 13 for targeted ads, which is a no-no under COPP. YouTube itself had issues with this back in 2019, right? Now creators have to flag content as made for kids, and that turns off data collection, personalized ads, comments. Disney put out a statement committed to kids' privacy, said the settlement was just about YouTube, not their own platforms.
It really shows the heat is still on big tech regarding data privacy, especially for kids. It's a constant reminder for companies online, particularly those with kid-focused stuff, that they have to navigate these evolving rules very carefully. And it impacts how they deliver content, how services work, balancing engagement with compliance.
Okay, one last quick tech one. Netflix. They're tweaking their Moments feature. Now, you can customize and share clips on mobile. You pick the start and end points, the clips get saved in your My Netflix area, you can rewatch or share them from there.
Making it easier to share those viral bits.
Exactly, capitalizing on things like that Wednesday dance scene. That show became their most popular ever, partly thanks to viral moments like that. It fits into their bigger picture too, right? Redesigning the homepage, the TikTok-style vertical feed on mobile, plus the business stuff like the ad plan and password crackdown.
Yeah, it definitely shows streaming platforms adapting to how people actually use content now. Social sharing is key. By making clips easier to share, Netflix basically turns users into, well, organic marketers, leveraging viral stuff to pull in new viewers, keep current ones engaged. It's about plugging into that wider online conversation, that whole moment culture.
All right, let's pull back a bit now. Talk about the broader economy, some big policy debates happening. The labor market, for one, looks like it's cooling off. The JOLTS report job openings and labor turnover showed openings fell to 7.18 million in July. That's a level we haven't really seen much since the pandemic, lowest since September 2024, actually. It was also below what forecasters expected.
So fewer jobs open than anticipated.
Right. Experts are calling it a turning point, maybe another crack, in what was a really tight job market. We'll need to watch the next reports closely, weekly jobless claims Thursday, and the big August jobs report on Friday.
Yeah, that cooling could help ease inflation, which the Fed wants. But it also signals potential risks for economic growth overall. For you listening, a cooling job market. Well, it could mean less frantic competition for workers in some areas, but maybe fewer opportunities popping up too. It's a tricky balance, and the Fed is watching this very closely.
And speaking of the Fed, they're in a really complex spot right now. Lots of political pressure. Their latest Beige Book report, that's their anecdotal summary from across the country, it said economic activity and employment were mostly little changed or unchanged recently. Prices rose moderately or modestly, obviously, but importantly, their contacts mentioned economic uncertainty and tariffs as negative factors.
Okay, so a sort of steady, maybe slightly slowing picture with uncertainty looming.
Pretty much. Now, the expectation is they'll probably cut interest rates slightly, maybe a quarter point, at their meeting later this month. Chairman Powell has talked about labor market risks proceeding carefully. But you have President Trump demanding much lower rates, sharply lower borrowing costs, and he's actively trying to reshape the Fed's board. Like, he's trying to fire Fed Governor Lisa Cook. She's fighting it in court, still in her job for now. And key Republican senators, Mike Rounds and Tom Tillis, they've said they won't even consider a replacement for her until her lawsuit is done, citing due process, worries about making the Fed partisan.
Wow. That's a direct challenge to the Fed's structure and independence.
It is. And meanwhile, Trump's nominee for another open Fed seat, Stephen Miran, he's got a confirmation hearing coming up. Now, Miran says he'll uphold the Fed's independence and its dual mandate, that's maximum employment and stable prices. But in the past, he has backed Trump's view on rates and argued for more presidential control over the central bank. So mixed signals there.
Yeah.
Reports say global central bankers are worried, warning that this pressure from Trump threatens the Fed's long-term political independence.
This whole debate around Fed independence, it's just so critical. It really goes to the heart of our financial system's stability. Its ability to react to economic problems without political meddling. When politicians publicly lean on the central bank, it can spook markets, undermine the Fed's credibility, and that affects everything from your mortgage rate to your investment stability. What's happening with Governor Cook and the Miran nomination, these are really significant tests of those institutional norms.
Again, another policy front also involving the government and private companies. The U.S. government invested $8.9 billion in Intel stock, took a 10% stake at a discount, and this immediately sparked a debate about, well, socialism.
A 10% stake in Intel, that's significant.
Yeah. Senator Rand Paul called it a step toward socialism, a bad idea, worried about diminishing the free market movement. But President Trump, he called it a great deal for America and also a great deal for Intel. And interestingly, independent Senator Bernie Sanders actually supported it, arguing against corporate welfare without getting anything in return. Kind of fits a pattern we're seeing, right? More government intervention in specific companies, NVIDIA chip sales, MP Materials, U.S. Steel.
Right. This Intel investment really throws those fundamental questions into sharp relief, doesn't it? Free markets versus national security, or strategic industrial policy. Critics see government overreach, maybe distorting the market. Proponents see it as necessary to secure vital domestic supply chains, especially for tech like chips. For you, it reflects this ongoing tension. How much should government step in to protect or boost key industries? And what does that mean long-term for competition, for innovation?
And shifting to a major social policy change. This one's in Florida. The state just announced it's becoming the first ever in the U.S. to withdraw from all state vaccine mandates, including the ones for kids to attend school.
Withdraw from all mandates, including childhood ones like MMR.
That's the announcement. It came from the state Surgeon General Joseph Ladapo, who's known as an immunization critic. He called mandates drips with disdain and slavery. He's been controversial before, like calling to halt mRNA COVID shots based on what reports called false claims.
Wow, that's a very strong stance.
It is. And the potential impact is huge. This could mean fewer kids getting vaccinated against diseases like polio, measles, basically rolling back requirements that are credited with boosting vaccination rates and stopping outbreaks. Florida already leads the Southeast in non-medical vaccine exemptions for kindergartners, apparently. Just for context, CDC research estimates vaccines saved over 1.1 million kids' lives and $540 billion in healthcare costs in the U.S. over 30 years. And federally, there are reports HHS Secretary Robert F. Kennedy Jr. is also looking to change U.S. vaccine policy, things like gutting an immunization panel, canceling mRNA shot funding.
This move in Florida really puts that ongoing tension between individual liberty and public health policy front and center. Vaccine mandates, historically, they've been a key tool for preventing infectious diseases, but they always spark debate about personal choice, government power. Understanding the different views here and the data, like those CDC figures, it's crucial for grasping the potential impact of this kind of policy shift, especially for schools and communities.
Okay, one last market trend to quickly hit before we wrap. Gold. It's trading around $3,549 an ounce. That's up about 42% from $2,500 just a year ago.
Gold doing what gold does in uncertain times.
Exactly. Playing that traditional fear hedge role. Wars, trade tensions, worries about U.S. debt, fears over Fed independence. It all pushes investors towards gold. Just to make it relatable, if you bought one of those Costco gold bars last year for about $2,679, you'd have an unrealized gain of around $870 today. That's a 32.5% jump.
Not bad, but selling isn't always straightforward, right?
Right. You usually get maybe 5–10% less than the spot price from dealers when you sell. And taxes are important. Physical gold is treated as a collectible by the IRS, so long-term gains. They're taxed at ordinary income rates but capped at 28%. Plus, you might have state taxes and maybe that net investment income tax if you're a high earner.
So the headline price isn't the full story for an individual investor. But yeah, gold's surge is really a classic sign of investor nervousness. It's actually beating bonds right now as a portfolio safety play. That reflects this global unease about the economy, about geopolitics. For you, it's just a reminder that when things feel shaky, traditional safe havens tend to shine again. But you really need to understand the actual costs, the tax implications, if you're thinking about that kind of investment.
Wow, okay, that was definitely a deep dive today. We really covered a lot of ground from influencer marketing boosting stocks to the absolute cutting edge of quantum computing to real shifts in the job market and these huge policy debates that are reshaping things. Every one of these stories really is influencing the world you navigate day to day.
It really is. And it leaves us with a question, maybe something for you to think about. As technology just keeps accelerating, I mean, at an unprecedented pace,
Yeah.
and governments are wrestling with these really complex economic, social challenges, how do you see the balance shifting in the coming years
Hmm.
between innovation, regulation, and individual choice? What kind of impact do you think these trends will have on your life, your work, maybe your community?
Good question to ponder. Keep digging, keep asking questions, keep connecting those dots. That's what the deep dive is all about. Until next time.